Greetings and welcome to Investment Strategy Brief for July and August of 2026. So in the middle of the summer, we tend to do one episode for the 2 months. And we want to basically provide a general update: Middle East, AI, Fed policy, earnings, market dynamics. So let's jump in first to the Middle East. You know that we monitor a variety of geopolitical risks around the world, things that are either happening or could happen. And a while back, we had to sort of break out a separate page for the military conflicts. And of course, the Middle East situation is right in focus, right? And so this has been an on-again, off-again kind of thing. It started in March, and recall early on, we published this article with 4 scenarios. So regime change, probably not going to happen. Severe tail, is it going on for a very long time? Probably not going to happen. Shadow war, hey, the U.S. claiming victory, but then the conflict continuing, likely not going to happen. So ultimately, we still think managed off-ramp, which back then we assigned a 50% probability to, we still think that's where we're headed, but it's going to be bumpy, right? We had this time where we had an agreement to negotiate a fuller peace agreement over 60 days, and then ultimately Iran violated some of that. Finally, the U.S. countered. There was a bunch of exchanges of attacks, and then recently, over this last weekend, the U.S. backed off and basically pointed again to the possibility of restarting negotiations. So oil prices went up, they've come back down a little bit, but ultimately think of it as a bumpy road to the managed off-ramp. And one concept that becomes ever more clear, and it's really Trump's approach to this, is coercive diplomacy. So the idea of saying, hey, what we're going to do is ultimately attack, have threats of attack, and try to get Iran back to the negotiating table, but in a stronger position for the U.S. So it's becoming pretty clear that this is ultimately an approach that Trump utilizes, and that continues to be the case in the current situation. We did pen an article this week on this topic more broadly. If you get the slides to this session, you'll see a link at the bottom of the page. You can check out the deeper article. But this concept of coercive diplomacy. Now, markets reacted, right? So for a while, when we had this peace agreement, oil prices fell, the futures fell. That's something we watch. The futures will give us a sense for worry. And then when the things resumed, the attacks resumed, everything moved back up since the weekend, when the beginning of the weekend, when it was decided to sort of back off the attacks. Things have calmed back down some. So I think a lot of oil volatility, worries about inflation, things like that. And ultimately, the markets have moved around a bit. But I'd say there's 2 things that kind of anchor to what's been happening. Number one is that, generally speaking, the equity markets against this Middle East conflict have been reasonably robust, meaning since the beginning and the issues that ensued, markets are ultimately higher. Now, they've moved around a little bit recently, a little bit of volatility, but probably for reasons beyond the Middle East. Number 2, then, is the idea of a higher for longer rate environment, probably anchored some in the idea of a worry about continued sustained inflation, but also, of course, as we've talked about and we'll get into in a moment, that idea of fiscal trajectory and sort of worries about federal debt, the buildup of federal debt, and investors wanting to be paid more for that, which translates to higher rates. So anyway, as it relates to the Middle East, though, just think of it as a bumpy road to a managed off-ramp. Now, turning to the economy, resilience remains the sort of the word that captures how things have been going with the economy. Think of it as trend growth rate. Since the beginning of the century, the average growth rate has been 2.1% on real GDP. 2/3 of that on average or overall recently related to the consumer. So we keep a close eye on the consumer. When we look at retail sales, personal consumption, numbers are positive. They're a little volatile, but they're positive. That's despite confidence and sentiment trending a little bit lower, being lower than normal, given, I think, everything that's going on in the environment. And another crack we look for is any kind of trouble when it comes to consumer credit. And at this point, we're not seeing any, right? So it's almost like the consumer's been hanging in there. The economy has remained positive. We haven't seen risks of recession here at this point. And the consumer's sort of support for the economy can be anchored as well in the job market. So we remain at close to full employment, unemployment, the rate down at 4.2%. Jobless claims down a little bit recently. jolts job openings above the sort of pre-pandemic level, not as high as the reopening, but above the pre-pandemic level. But we've seen a little bit of softness in non-farm payrolls for a bit. And so you can almost think of it as a full employment below hire, low fire kind of situation. And so again, overall, people seem pretty satisfied in the job market. Now, we've talked a lot about inflation heating up recently. We've seen just a little bit of a reversal of that in the last few prints. And think of it as potentially related to those oil prices coming down. But ultimately, this is a big focus, of course, for the Fed, especially under Kevin Walsh. He's sort of made a commitment that they want to get inflation under control. And the way you do that, to the degree they can operate and apply tools, really relates to hiking rates. And so actually, as I record this, the Fed's meeting tomorrow, so it's Tuesday, tomorrow, Wednesday, they're going to conclude their meeting. They're going to announce their policy. We expect it to be an unchanged rate at tomorrow's announcement, but we'll see how that unfolds. But we also think that there's a debate going on about whether or not to hike rates given this inflationary environment that we've continued to be in. And in fact, if we look at futures, basically there's now once again an expectation of two rate hikes in the quarter point hikes in the reasonably near future. And of course, we know when we look around the world to places like Bank of Japan or the ECB that we've seen some hikes in places recently. So we're mindful that the U.S. could follow suit basically and be sort of in alignment with what's been going on globally. In any event, coming back to the trend growth rate, the consensus forecast for full 2026, it's at 2.2%. This has gone up a bit. It's come down a little bit. It's probably come up a little bit here. And then the 2027 forecast, no recession, but instead for continued growth right around that consensus growth line. So people are really watching to see if we can find cracks in the economy, but especially, and I'll get into this in a moment, as it relates to AI investment and the excitement about AI. Nobody's expecting a lot of weakness anytime soon. Now, before we get to that, which we'll include a little bit of that in the equity discussion, let's talk about rates and fixed income. So I mentioned higher for longer. So just in general, the curve, right, the Treasury curve, which represents kind of an anchor interest rate, is up just a little bit. And again, we talked about sort of worries about inflation. We talked about fiscal trajectory, and essentially investors wanted to be paid a little bit more, given that there's a buildup in federal debt, and therefore there's the impression is a little bit of risk associated with those, especially those longer-term investments. So we've seen the 10-year rate, for example, that's sort of a benchmark bellwether rate that people keep an eye on is just up a little bit, and so that's something that we'll keep an eye on. Now, when it comes to forward-looking investment yields in fixed income, the net result of that is that yields across various categories of fixed income are a little bit even more attractive. And so when we keep this chart going, just to remind ourselves how low the rates were for a while, but ultimately rates have become quite attractive. Now, I mentioned the idea of fiscal trajectory. So we know that this idea of spending, round numbers, around $2 trillion a year, more than we take in terms of tax revenue, just continues to increase the debt. And people express worry about that. We've penned articles about it around different scenarios that can unfold to essentially resolve this issue, but it remains something that is in keen focus for us and most. And then when we look at performance in the fixed income realm, and if we focus, for example, on year to date, you'll see for the Bloomberg aggregate, for example, a slightly negative number. Now, these are investments that earn an interest rate, right, a coupon rate on bonds. So how do you get a negative number? Well, you get that by the fact that when interest rates go up a little bit, as we've discussed, the price of the bond goes down. And so that's what we've seen in the general investment grade market as measured by this aggregate index. We've basically seen rates go up, prices go down a little bit, just enough to offset the positive return from a half a year, roughly, of that coupon rate. And so that's the kind of environment in. Think of it as we're generally flattish in the bond market, but forward-looking yields, again, are pretty attractive. Now, turning to equities, we've talked a lot about the resilience of the environment. We've seen profit margins remain positive, expected to be even better. We've seen earnings growth often exceeding expectations. And so there's just this general sense of optimism in the market, and that is embedded in the valuation. So with the market level where it sits today, we happen to track in this chart, the S&P 500 is just under 20% premium of its PE to its 10-year PE average, right? So the market continues to be overvalued by that metric. Now, when we look on an equal weighted basis, it's more normal, more closer to a long-term average. And that we've talked about that, the idea that a concentrated part of the market has performed extremely well. We've talked about a rotation, and we're going to show some data in a moment that kind of unpacks that. But here is a chart that just shows us the concentrated names and how, of the top, in this case, the top 10 stocks in the S&P 500 are making up an increasing amount of the index overall. And so that's something that has everybody's attention. Now, another thing, I mentioned AI and AI investment. This is just one example of looking at some of the hyperscalers. So Google, Meta, Microsoft, Amazon, and you can see these are free cash flow. So this is sort of cash flow that they have available to invest in capital investments if they want, or pay dividends or other things. And the bottom line is that it's been growing and pretty reasonable. This year and next year, it's gone down a little bit because they're making the CapEx investments. And why do they do that? To earn a return. So you can see the forecasts for extra cash flow, free cash flow that can be earned in part from these investments are expected to go up. So that's sort of a nice visual explaining sort of the investment and what is expected to happen as a result of the investment. Now, another pattern is to when we look at the top 50 performing companies in the S&P 500 year to date by sector, it's a good chunk of them, 30 of them sit in the technology sector. So to give you a sense for the dominance of that sector. Now, here's another analysis that we were finally able to put together. So take a moment to explain it. So we've seen an interesting pattern in the small cap space. A lot of small cap managers will perform or apply their approach by investing in quality companies. And that feels comfortable, right? Hey, it's a company that's posting positive earnings, things like that. And so the punchline is, people kind of think, oh, that's a safe investment, a safer investment. Maybe it'll earn a better return over time. And so what we did was to take the Bloomberg 2000 sort of diversified small cap index. And then we said, look, we want to take out of that index and create a separate cluster of any of those stocks that also sit in the S&P 600. The S&P 600 happens to be a higher quality and more concentrated small cap index. So it's sort of an objective measure of quality. And I think it has to do, I believe, to get in that index, you have to have 4 consecutive quarters of positive earnings. And then there's the rest of them. So those are all the other companies in the Bloomberg 2000 that don't meet that threshold. Okay, so if we look at that differential, when the line's going up, that means the quality stocks are outperforming. And then as the line moves down, that means the lower quality stocks are outperforming, meaning the quality is underperforming. And so what you can see quite dramatically is this huge swing from kind of a positive 40% effect to a negative 40%. So just a very big swing in these returns. And so long story short, it's what's called a 2 standard deviation event. You can see every time in the past when it gets down to that level, it tends to bounce back. And so people are expecting a reversal. And again, it's been an interesting environment because many of those managers that focus on quality have been underperforming, really related to the pattern of the market and the fact that their approach with the kinds of stocks they're buying happen to be out of favor, where when we look at history, that pattern often reverses. So again, just a little bit of information that we thought would be helpful. Anyway, to take a zoom back out and take a look at the broader performance patterns, I think one thing I want to focus on year to date here is 2 things. One is the Mag 7. So you look year to date, basically a slightly negative number. This has been a very dominant cluster of stocks, and it's informed, as we've talked about before, and influenced the cap-weighted market, the market cap-weighted market, and that's captured, for example, at the top line, the S&P 500 index. We've talked about a broadening, that leadership would move beyond those companies, and that one way we could measure that is the equal-weighted index, which you can see year-to-date is modestly outperforming the cap-weighted. So while it's a modest amount, we have seen that broadening so far year-to-date in 2026. It's moved around a little bit, but as of this recent print, that's what we're seeing. Now, one final point on equities, as we've talked about before, we talked at the beginning of this Middle East crisis that markets will go negative and then they tend to recover. And we went and looked at a whole bunch of other geopolitical shocks and reminded ourselves that not always, but most of the time, the markets recover. And lo and behold, when we look at this most recent one over the 3 months after, and then ultimately building to the 6 months after, essentially things are looking pretty good. And so recovery, as we talked about earlier. Now, looking to longer term themes, we keep a close eye on the build out of AI, the strength of the models, how companies are deploying it across the economy. We know that's happening in all kinds of places, creates lots of good investment opportunities and risks. So something that we keep a close eye on. We've talked a lot about the idea that whether it's hyperscalers and CapEx investment or companies investing in AI, shareholders continue to look for evidence of a positive return on those investments. So we've talked and written a lot about that. And then we are mindful of some dislocations. There's almost like segments of the market, certain industries, types of companies, where the speculation is that AI can kind of take over and perform well against established companies. So certain companies have performed poorly. Honestly, you look at software, there was weakness. Now there's been some recovery. So these are things where we get into the fundamentals. We look at what's happening with companies we invest in. But ultimately, you see these patterns, almost like an emotional reaction to the various changes and improvements and innovations you see in artificial intelligence having an effect on that. So with that, I'll just remind everyone that part of our work is long-term themes. We look to try to understand how the world is evolving, how sort of value is created in the economy, and frame that up, and that informs how we invest, of course. And then finally, just to close out, I always want to remind folks to check out stifelinsights.com. This is where this video is posted, but a bunch of other work that we do. I invite you to check out that website. And again, here we are in the middle of the summer, but I'll look forward to seeing you at the end of the summer for our next session. Thanks so much for watching today. Thank you.